oh my goodness, we have to do something about this. So I think the momentum's going to continue building out there. And the most important thing is to get on the right side of change. Most of this volatility is algorithmically generated. Algorithms are not doing the research that we're doing. Anyone who sold during that moment of drama regretted it for the rest of the year. Algorithmic selling in the market definitely has hurt Bitcoin because many people are not looking to it as a store of value the way they are looking to gold as a store of value and safety in a time of trouble. Unlike the tech and telecom bubble, this is the real deal. Unlike the tech and telecom bubble, people are scared to death. As a portfolio manager in the world of innovation, I would prefer fear and climbing a wall of worry than the speculative excesses that we saw in the tech and telecom bubble.
Wood begins by acknowledging the obvious. Gold has outperformed Bitcoin decisively. In a time of geopolitical uncertainty and risk aversion, investors have gravitated toward the traditional safe haven. Bitcoin, by contrast, has been swept into broader algorithmic sell-offs. The distinction, she suggests, is psychological rather than fundamental. Many market participants still do not treat Bitcoin as a true store of value. Instead, it trades like a high beta risk asset, vulnerable to indiscriminate liquidation when volatility spikes. Before we go on, please take a moment to like this video, subscribe to the channel, and turn on post notifications for more content like this. Every action helps with the YouTube algorithm and greatly supports the channel's growth. Thanks for your support and enjoy the video.
We have to acknowledge that gold has way outperformed Bitcoin. Bitcoin has gotten caught up in this risk-off, in a certain sense, dynamic where, you're getting wholesale drops in sectors. No, sell now, ask questions later. It's certainly happened in the SaaS space. It's happened in the wealth management space. It's happened in the trucking broker space. So this, algorithmic selling in the market definitely has hurt Bitcoin because many people are not looking to it as a store of value the way they are looking to gold as a store of value and safety in a time of trouble. Now, we don't understand that because gold supply growth is, we believe, accelerating. Bitcoin supply growth cannot accelerate. Now, quantum computing, we talked about that. We talked about all of the worries that are going around in the Bitcoin community, especially as the ETFs have gotten involved. So we had newer holders, probably weaker holders, and when they're confronted with those risks, they'll again sell and ask questions later. You can see, though, that the uptrend, higher lows, in a major way. Sure, we broke the one, I guess, from 24, but that uptrend, general uptrend, has not been broken. And I don't think it will be broken. Now, could be famous last words, but a lot of technicians are involved in the market right now. In fact, that's all they're doing. And it's astonishing to me that some of the people that are so steeped in the research of Bitcoin and other crypto assets have defaulted to technical analysis as this move has taken place. Well, if you're a technician, look where we are now, and you can see that's where we topped in 2017. So that's kind of a marker. There's also some support you can see there in the 2022-23 range when Bitcoin was actually a refuge for those who were very scared of the regional bank crisis turning into a much broader financial crisis with counterparty risk a la 0809. That cannot happen to Bitcoin. And definitely I encourage people to self-custody if they want to hedge a bit against counterparty risk, because we do have the ETFs now involved in ownership. So it's been grueling, but it's also been, I don't love these periods because I worry about our clients. We use these periods. We've been buying in the crypto space in our various strategies. But this is the time where, you learn about everybody's fears, and I described them in the last in the know video and how we've addressed them. But you learn about other developments in the crypto asset ecosystem. And I have just gotten involved in an advisory role with a company called Layer Zero, which is trying, from a DeFi point of view, trying to go back to the future and not compromise the way Ethereum has and other blockchains with layer 2s and so forth, but actually go back to the future and develop an ecosystem for this new age, the agentic AI age, where there's going to be a lot of activity, machine to machine, that can handle 2 to 4 million transactions per second. Ethereum can only handle 13. Solana maybe 2,000. So, it's very interesting that during tough times, the builders in this community are heads down. And so our research surfaces some of this new activity these new approaches, because they're starting to talk more about them in the context of the way the DeFi ecosystem is currently set up.
Wood invokes a familiar but powerful concept. Bull markets climb a wall of worry. Last April's tariff-related turmoil shook even seasoned investors. Those who sold during that panic, she notes, regretted it as markets subsequently recovered. Today's volatility feels intense, but she contrasts it with the late 1990s technology bubble. Unlike that era, when speculative excess dominated and fear was minimal, today's environment is characterized by skepticism and caution.
The environment, which has been extremely volatile recently. I think, we've been talking about AI since ARK was founded in 2014. We've been all over it. That's when we took our first NVIDIA position. And so we've been doing a lot of research, and we've, I think, been doing very well in terms of understanding how this environment is going to evolve. In the last In the Know, which was an interim one, I described how we did anticipate a shift in terms of incremental share away from SaaS as platform as a service, basically usurped the role of SaaS and really helped customize for each company their own platform instead of using a one-size-fits-all. So that wasn't surprising, but as usual, the market throws the baby out with the bathwater, or maybe it's the investors or the speculators. And so, as usual, we consolidate our positions to our higher conviction names. But, most of this volatility is algorithmically generated. Algorithms are not doing the research that we're doing. And so that is why we concentrate towards our highest conviction names. The market gives us that opportunity. So that's been, those are our comments around the volatility. And you'll remember last April during tariff turmoil, I was on here saying, look, We think this is temporary, what's going on in the market. Remember, there was a sharp decline, and a lot of people were freaked out. Even investors who typically are very calm and used to volatility, they were shaken last year. Anyone who sold during that moment of drama regretted it for the rest of the year. The market has been up very strongly since. This market is climbing a wall of worry. Those are the strongest bull markets. The volatility does shake people up. But frankly, this is so much healthier an environment than what we experienced during the tech and telecom bubble. Unlike the tech and telecom bubble, this is the real deal. Unlike the tech and telecom bubble, people are scared to death. As a portfolio manager in the world of innovation, I would prefer fear and climbing a wall of worry than the speculative excesses that we saw in the tech and telecom bubble. Now, you might say AI is going through that. That's been part of the worry in the market. We don't think so. All the research we're doing would suggest that we are in the equivalent of 1996 in the technology or the internet revolution that was taking place back then. Very, very early. And sure, it went into overdrive. It went crazy. But in 1996, that was the year that Fed Chairman Greenspan talked about irrational exuberance. And, that scared people because they thought he was going to tighten to curb speculation. But effectively, he said he wouldn't do that. He'd let the market work. And we all learned a lot of lessons because of what happened after that. And the scar tissue in the market today because of that is happening or is here because those who have gone through the tech, who went through the tech and telecom bubble, are gray hairs in our business now, and they have that scar tissue, muscle memory, whatever you want to call it, and they're saying, as the most seasoned investors, I am going to protect my firm against this risk, and I think that is what's keeping the fear and this wall of worry going. It's volatile. It can be uncomfortable. But just like last April, these can be very important opportunities to invest in the next big thing. And we're ready for prime time. We can see the explosion in AI, and we can all feel the ground shifting underneath us. And, I can see and hear CEOs now saying, oh my goodness, we have to do something about this. So I think the momentum's going to continue building out there. And the most important thing is to get on the right side of change. In the 70s and 80s, the bond market was vigilant and focused on the twin deficits. One was the federal budget deficit, and the other was the trade deficit. And you can see what happened to the trade deficit during COVID and its aftermath. Imports boomed, and we went into a very steep deficit, as you can see here. That also is changing, and many people in the foreign currency markets use the trade deficit as their gauge of where the dollar is going to go. And if we're importing a lot more than we are exporting, the fear is that the dollar will go down. There are excesses developing in the market. And so you can see we've corrected this. Of course, tariffs, the steep decline there was front-running imports because of tariffs, impending tariffs. And now we've seen the other side of that. If we're right, and I was surprised at how limited the deficit was just a few months ago. If we're right, and the U.S. is going to surprise on the high side of expectations in terms of real GDP growth, and that the return on invested capital in the United States is going to go up because of tax cuts and deregulations and the tariffs, well, then we're probably going to see more import growth, not because of tariffs, of course, but for the first two reasons, more import growth, and we will continue to have a deficit. Now, we have never really worried about a trade deficit because when you take into account the entire picture, the other side of a trade balance, which is goods and services, the other side of that is a capital surplus. Again, money attracted from the rest of the world because of the good environment we typically enjoy here in the United States from a business friendliness and capital friendliness point of view. So I just thought I'd talk about the twin deficits because I know people worry about them. And we can see on the trade deficit, I've just explained why we don't worry about that. On the federal deficit, we are seeing a nice improvement in the deficit as a percent of GDP. I also wanted to depict where the dollar is. I know I've shown you this chart before, but this is the other worry out there. You hear lots of talk about the end of U.S. exceptionalism. Whatever that means, it probably means something different to different people. But from an economic point of view, I would say we have not. In fact, we're probably going to see an explosion in activity here in the United States because of this technology revolution. The U.S. and China are leading that charge. And so I do believe that the dollar is going to turn around and move in the other direction. Sure, it's gone down, mostly for political reasons, I would suggest. Countries are diversifying away from the dollar into gold and other currencies. But we think this is going to change. It reached an extreme, especially given where the gold price has been. But look what happened to the dollar. If you look at this chart, put this into perspective, this is not a collapse in the dollar. And if you're a technician, you'd say, hey, the dollar is held where you would have expected it to hold, where it last peaked, as shown with the black line.
Cathie Wood's message is ultimately forward-looking. Bitcoin's volatility does not negate its structural scarcity. AI's disruption of SaaS does not diminish its transformative power. Trade deficits do not equate to decline. Dollar weakness does not signal collapse. Instead, we are witnessing the early innings of a technological revolution unfolding amid skepticism. Markets are volatile because change is profound.